The world has never produced more wealth than it does today. Markets are at record highs. Governments report growth. Corporations announce historic profits. And yet, across continents, across professions, across generations, people feel poorer than ever. This is not a feeling problem. It is a structural one. If the economy is growing, but life is getting harder, then the numbers are not lying by accident. They are lying by design. This is not a story about laziness, bad choices, or personal failure. This is a story about where the money went, who captured it, and why most people were never meant to feel it. The global economy has never looked stronger on paper than it does today. Headlines announce record-breaking stock markets, expanding gross domestic product, and unprecedented levels of global wealth. Corporate earnings reports speak the language of abundance. Central banks present charts showing recovery, resilience, and growth. Governments celebrate expansion as proof that the system works. From a distance, the numbers suggest a world moving forward with confidence, momentum, and prosperity. Yet beneath this surface, something fundamental feels wrong. Across countries, cultures, and income brackets, people feel poorer, more insecure, and more financially anxious than ever before. This contradiction is not emotional. It is structural. Global output, measured by gross domestic product, has expanded dramatically over the past decades. Adjusted for inflation, the world now produces several times more goods and services than it did in the late 20th century. Technological progress has accelerated productivity. Supply chains span continents. Capital moves instantly across borders. In theory, this should translate into broad-based improvements in living standards. And statistically, it does, if one looks only at aggregates. Average income has risen, average wealth has grown, average consumption has increased. But averages are deceptive instruments. They smooth inequality into invisibility and convert divergence into illusion. The central flaw lies in the way modern economies measure success. Gross domestic product counts activity, not well-being. It rises when rents increase, when medical bills grow, when financial transactions multiply. It rises when housing becomes less affordable, when debt expands, and when crises generate emergency spending. It does not distinguish between productive investment and speculative churn. It does not account for distribution. A surge in wealth concentrated in a narrow segment of society lifts the total just as effectively as widespread income growth. On paper, both appear as progress. In lived reality, they are opposites. Over the past years, a disproportionate share of global economic growth has flowed into financial assets rather than wages. Equity markets have reached historic highs, driven by liquidity, low interest rates, and aggressive asset purchases by central banks. Real estate prices in major cities have multiplied, far outpacing income growth. Bonds, private equity, and alternative assets have absorbed trillions in capital, seeking returns in a low-yield world. This expansion of asset values creates the appearance of universal enrichment, but only for those who own them. For the majority, whose primary source of income is labor rather than capital, these gains are largely inaccessible. Statistical agencies often report rising household wealth, yet this wealth is heavily skewed. The top segment of households holds a dominant share of equities, investment properties, and financial instruments. When markets rise, their balance sheets expand exponentially. Median households, by contrast, hold limited financial assets and are more exposed to inflation in essentials such as housing, energy, food, and healthcare. When asset inflation outpaces wage growth, the result is a widening gap between reported prosperity and lived experience. People are told the economy is booming, while their rent absorbs a growing share of income and their savings lose purchasing power. Inflation further distorts perception. Official inflation metrics rely on baskets of goods that fail to capture the real cost pressures faced by households. Asset prices are excluded. Housing costs are often understated through imputed measures rather than actual market prices. Education, childcare, and healthcare inflate faster than general indices, yet they are structural necessities, not discretionary luxuries. When central banks declare inflation under control, they refer to a narrow statistical construct, not the economic reality households navigate daily. Recent global developments have intensified this divergence. Supply chain disruptions, geopolitical tensions, and monetary tightening have reshaped price dynamics. While inflation rates may moderate in headline terms, cumulative price increases persist. Wages adjust slowly, if at all. Purchasing power erodes not in a single shock, but through gradual compression. People do not suddenly become poor. They feel poorer as the margin between income and survival narrows year after year. Another layer of illusion emerges from financial engineering. Modern economies are increasingly driven by credit expansion rather than organic income growth. Debt fuels consumption, supports asset prices, and sustains growth statistics. Governments borrow to stabilize systems. Corporations leverage balance sheets to buy back shares. Households rely on credit to maintain living standards. This debt-driven expansion inflates economic output while masking underlying fragility. Growth appears strong, but it is borrowed from the future. When people sense that their stability depends on constant leverage, insecurity becomes rational. Global news reinforces this contradiction. Reports celebrate market rallies alongside stories of housing shortages, declining birth rates, and record levels of financial stress. Productivity gains coexist with burnout and precarity. Employment numbers improve while job quality deteriorates. The economy grows, yet trust in the future collapses. This is not psychological inconsistency. It is the natural outcome of an economy optimized for capital efficiency rather than human stability. At the heart of this paradox is distribution. Wealth creation has not slowed, it has accelerated, but its allocation has become increasingly asymmetric. Financial globalization rewards scale, ownership, and access to capital. Labor, fragmented and globally competitive, loses bargaining power. Technology amplifies returns to capital while compressing wages. Monetary policy stabilizes markets but inflates assets. Each component reinforces the same outcome: impressive numbers, hollow progress. People feel poor not because the world lacks resources, but because the mechanisms that translate growth into shared prosperity have weakened. The social contract implicit in post-war economic models has eroded. Growth no longer guarantees security. Productivity no longer ensures higher wages. Stability no longer follows employment. When these expectations collapse, perception aligns with reality rather than statistics. The world is richer than ever by measurable standards, but wealth that cannot be accessed, relied upon, or converted into security does not feel like wealth. It feels like distance. It feels like exclusion. It feels like watching numbers rise on screens while life becomes more expensive, more fragile, and more uncertain. This is the first layer of the modern economic illusion. Abundance without accessibility, growth without comfort, prosperity without peace. Money did not disappear. It moved. That is the core reality hidden behind the question of why prosperity feels absent despite visible growth. When people ask where the money went, the honest answer is uncomfortable. It went where the system was designed to send it. Modern economic growth has not vanished into thin air, nor has it been destroyed by inefficiency. It has been absorbed, concentrated, and locked inside structures that reward ownership over participation and scale over contribution. Over the past decades, the architecture of global capitalism shifted quietly but decisively. Economies once centered on production, wages, and consumption gradually transformed into systems dominated by finance, assets, and leverage. This process, often described as financialization, changed the destination of growth. Instead of flowing primarily into incomes, it flowed into balance sheets. Instead of raising living standards broadly, it inflated the value of things already owned by those at the top. One of the most striking indicators of this shift is the divergence between asset prices and labor income. Equity markets have expanded at a pace that far exceeds economic output growth. Major stock indices have multiplied several times over in real terms since the late 20th century, driven not only by corporate innovation, but by monetary policy, global capital flows, and financial engineering. Real estate prices in global urban centers have experienced similar trajectories. Housing, once a utility and a store of modest value, became a speculative asset class. As capital searched for yield, property absorbed vast amounts of liquidity, pushing prices far beyond what local incomes could support. At the same time, wage growth lagged persistently. Adjusted for inflation, median wages in many advanced economies stagnated or grew marginally despite rising productivity. This decoupling is not accidental. Productivity gains increasingly accrue to capital owners through automation, globalization, and network effects. Corporations generate more output with fewer workers. Supply chains reduce labor costs by arbitraging wages across borders. Digital platforms scale revenues without proportional increases in employment. The result is higher profits, higher valuations, and limited wage pressure. Statistical aggregates conceal this redistribution. When national accounts report rising household wealth, they combine vastly unequal balance sheets into a single number. A surge in equity valuations held by a small fraction of households can lift average wealth dramatically, even as the majority see little change or outright decline. Median figures tell a different story, but they rarely dominate headlines. Growth is celebrated in averages because averages flatter the system. Another mechanism driving concentration is monetary policy itself. In response to crises, central banks deployed unprecedented liquidity measures. Low interest rates and asset purchase programs stabilized financial markets and prevented collapse. But they also reshaped incentives. Cheap money rewarded those with access to capital markets. Investors could borrow at minimal cost to acquire assets whose prices were supported by policy. This dynamic created a feedback loop. Rising asset prices justified further investment, which pushed prices higher still. Those without assets faced rising costs without corresponding income growth. Global capital mobility intensified the effect. Wealth increasingly flows across borders in search of safety, yield, and appreciation. Capital gravitates towards stable legal systems, deep financial markets, and scarce assets. This inflow raises prices locally while extracting value globally. Cities become investment vehicles rather than living spaces. Entire neighborhoods are priced according to global demand rather than local purchasing power. For residents, this translates into higher rents, longer commutes, and reduced economic flexibility. Corporate behavior further amplifies the imbalance. Instead of reinvesting profits into wages or long-term productive capacity, many firms prioritize shareholder returns. Share buybacks, dividends, and financial restructuring dominate capital allocation. These actions raise stock prices and executive compensation while contributing little to broad-based income growth. The firm becomes a conduit for value extraction rather than value distribution. Recent economic developments underscore this pattern. Even during periods of widespread disruption, financial markets often recover faster than labor markets. Asset holders benefit from rebounds fueled by policy intervention, while workers face prolonged adjustment. Headlines celebrate market resilience while households deplete savings and accumulate debt. The system protects balance sheets more efficiently than livelihoods. Debt plays a crucial role in masking this transfer. As incomes fail to keep pace with costs, credit fills the gap. Households borrow to maintain living standards. Governments borrow to sustain growth. Corporations borrow to enhance returns. This borrowing supports demand and stabilizes output, but it also obscures the underlying imbalance. Growth continues, but it is increasingly decoupled from income. The illusion persists until debt servicing consumes too much of future earnings. The concentration of money is not merely a distributional issue. It reshapes the entire economic landscape. When capital accumulates at the top, investment decisions prioritize asset appreciation over societal utility. Innovation focuses on monetization rather than resilience. Risk concentrates in financial systems rather than being dispersed across incomes. Economic volatility increases even as headline indicators appear stable. People sense this intuitively. They observe markets thriving while opportunities narrow. They hear about wealth creation they cannot access. They live in economies that grow without lifting them. This is not a failure of perception. It is an accurate reading of a system that channels gains upward by design. Growth did not trickle down. It pooled upward, hardened into assets, and withdrew from everyday life. This is only the first half of the story. Understanding where the money went requires confronting not only concentration, but the mechanisms that normalized it and made it appear inevitable. The concentration of money did not happen through a single policy or a sudden shift. It unfolded gradually, normalized by narratives of efficiency, inevitability, and modernization. What made this redistribution so effective was not secrecy, but legitimacy. Each mechanism appeared rational in isolation. Together, they redirected the flow of wealth with mathematical precision. One of the most powerful forces behind this normalization was the transformation of inequality into an abstract concept rather than a lived constraint. As long as aggregate indicators improved, distribution was treated as a secondary issue. Policymakers argued that growth would eventually lift outcomes indirectly. Investors framed concentration as a natural reward for risk and innovation. Economists emphasized efficiency over equity. Over time, the idea that capital should capture a growing share of returns became embedded in institutional logic. Tax structures played a subtle but decisive role. Across many economies, the burden shifted away from capital gains, inheritance, and corporate profits toward labor and consumption. Income from work remained visible, taxable, and rigid. Income from assets became flexible, mobile, and optimized. Wealth could be deferred, sheltered, or relocated. Labor could not. This asymmetry accelerated accumulation at the top while compressing disposable income below. The system did not confiscate wealth from the majority. It quietly prevented them from accumulating it. Financial innovation further widened the gap. Complex instruments, derivatives, and structured products expanded opportunities for those with capital, knowledge, and access. Returns became less dependent on real economic activity and more on positioning within financial networks. Volatility itself became profitable. Crises, rather than destroying wealth, often redistributed it toward those positioned to absorb risk. Losses were socialized through policy intervention, while gains remained private. This asymmetric protection reinforced confidence at the top and vulnerability below. Another overlooked factor is time. Wealth compounds, wages do not. Asset ownership benefits from exponential growth, while labor income grows linearly, if at all. Even modest differences in access produce vast divergence over long horizons. When capital markets deliver sustained returns, early ownership becomes destiny. Those without initial access fall permanently behind, regardless of effort. Over generations, this dynamic transforms inequality from a gap into a chasm. Globalization intensified these effects by expanding the scale at which capital operates. Corporations and investors could arbitrage regulations, labor costs, and tax regimes across jurisdictions. Workers remained local. Communities remained fixed. Capital became fluid, while labor stayed anchored. This mobility granted capital leverage in negotiations and policy influence. Governments competed to attract investment by lowering taxes and regulations, further privileging capital over labor. The result was not a race to the bottom in growth, but a race to the top in concentration. The psychological impact of this structure is profound. People are surrounded by symbols of wealth that are statistically real but personally unreachable. Market indices signal prosperity, while daily expenses signal constraint. The disconnect generates frustration, not because expectations are unrealistic, but because the rules have changed without acknowledgement. The promise that effort leads to stability eroded quietly, replaced by a reality where ownership matters more than participation. Media and political discourse often obscure this shift by framing outcomes as individual success or failure. Financial winners are celebrated as innovators. Financial losers are framed as uncompetitive. Structural dynamics disappear behind personal narratives. This framing absolves the system and internalizes blame. People feel poor not only materially, but morally, as if they failed a game whose rules were never explained. The final layer of illusion lies in resilience narratives. Economies are praised for bouncing back quickly after shocks, yet this resilience is uneven. Financial systems recover faster than social systems. Markets stabilize before households do. The speed of recovery becomes evidence of strength, even when it reflects the prioritization of asset values over incomes. What is called resilience is often simply the protection of capital. When all these forces combine, the outcome is predictable. Money accumulates where it can multiply most efficiently. That place is no longer the paycheck or the factory or the local business. It is the asset, the platform, the portfolio. Wealth becomes abstract, mobile, and insulated. Life becomes concrete, local, and exposed. The distance between the two grows until it is felt everywhere. This is why asking where the money went is the wrong question. The correct question is why it was allowed to stay. The system did not lose wealth. It reassigned ownership. And once reassigned, it redesigned itself to protect that outcome. Work is no longer the central mechanism through which modern economies distribute prosperity. That statement would have sounded radical decades ago. Today, it is simply descriptive. The relationship between labor, productivity, and reward has fractured. Not suddenly, but systematically. People are working more efficiently than ever before, producing more value per hour, supported by technology, automation, and global coordination. Yet the share of that value returning to workers has steadily declined. This is not a paradox. It is the outcome of a labor model redesigned to prioritize flexibility, cost minimization, and capital efficiency over stability and income growth. For much of the 20th century, rising productivity translated into rising wages. When workers produced more, they earned more. This linkage formed the backbone of the middle class in many industrial economies. As factories modernized and output increased, wages followed. Consumption expanded, savings grew, and economic security became attainable through employment. That model no longer defines the system. Productivity continued to rise, but wages did not keep pace. The connection was not broken by accident. It was severed by design. Globalization played a central role in this shift. As production networks expanded across borders, labor became globally interchangeable, while capital became globally mobile. Companies gained the ability to source labor from lower-cost regions without relocating ownership or profits. This arbitrage weakened the bargaining power of workers in higher-income economies and suppressed wage growth worldwide. The threat of offshoring became a silent constraint on compensation. Even when jobs remained local, wages were disciplined by global competition. Technology amplified this pressure. Automation replaced routine tasks, reduced labor demand in manufacturing and services, and shifted value toward those who owned systems rather than operated them. Digital platforms scaled rapidly with minimal labor input. A small number of engineers could support global operations serving millions of users. Revenues expanded without proportional increases in employment. Productivity gains accrued to shareholders and founders, not to a broad workforce. Labor became an input to be optimized, not a partner in growth. Employment statistics often conceal this transformation. Headline employment rates may appear strong, yet they mask a deterioration in job quality. Full-time, stable positions gave way to temporary contracts, freelance arrangements, and platform-mediated work. The so-called gig economy promised flexibility and autonomy, but delivered income volatility and weakened protections. Workers absorbed risks once carried by employers, including demand fluctuations, health costs, and retirement planning. Income became uncertain, even when employment was constant. Wage stagnation is frequently framed as a temporary imbalance or a skills mismatch. This explanation is convenient but incomplete. While skills matter, the broader trend reflects structural shifts in power. Labor unions declined. Collective bargaining weakened. Legal frameworks favored employer flexibility over worker security. Corporate governance emphasized shareholder value above all else. In this environment, productivity gains naturally flowed upward rather than outward. Real wage data illustrates the outcome. In many advanced economies, median wages, adjusted for inflation, showed limited growth over long periods, despite substantial increases in output per worker. Meanwhile, executive compensation and capital income surged. This divergence is not captured by average income figures, which are distorted by top earners. The typical worker experienced an economy that grew around them, but not for them. Cost structures intensified the strain. As wages stagnated, essential expenses rose. Housing absorbed a growing share of income. Education costs escalated faster than wages. Healthcare expenditures increased regardless of employment status. These costs are not optional. They define participation in modern society. When income growth fails to match them, economic stress becomes chronic. Even households with stable employment feel perpetually behind. Recent global developments reinforce these dynamics. Shocks disrupted labor markets unevenly. Some sectors recovered quickly, others did not. Remote work expanded opportunities for some, while eroding boundaries between labor and life. Productivity gains accelerated through digitalization, yet wage adjustments lagged. Inflation further compressed purchasing power. Employers framed restraint as prudence. Workers experienced it as erosion. The psychological impact of this environment is significant. Work no longer guarantees progress. Effort no longer ensures stability. Planning becomes difficult when income growth is uncertain and costs are rigid. Younger generations internalize this reality early. They delay milestones once associated with adulthood, not out of preference, but necessity. The promise that hard work leads to security feels outdated, because it is. This is the first layer of the broken labor model. Work still produces value, but it no longer distributes it. Productivity still rises, but compensation does not follow. Employment still exists, but stability erodes. The economy functions, yet the social logic that once connected labor to prosperity has weakened. Understanding this breakdown is essential to understanding why growth feels hollow and why feeling poor persists even in an era of unprecedented output. The second layer of the broken labor model lies not only in how work is paid, but in how risk is distributed. Modern economies have systematically transferred economic risk away from institutions and onto individuals, while preserving upside for capital. This shift reshaped the meaning of employment itself. Work no longer functions as a stabilizer. It functions as exposure. In earlier models, firms absorbed volatility. They smoothed cycles, carried inventories, maintained payrolls, and planned for long horizons. Workers exchanged loyalty and productivity for predictability. That arrangement eroded as competition intensified and financial metrics dominated decision-making. Firms optimized balance sheets by externalizing uncertainty. Flexible labor became a feature, not a bug. Variable hours, short-term contracts, and performance-based compensation allowed companies to respond instantly to demand fluctuations. Workers, in turn, became shock absorbers for macroeconomic instability. This transfer of risk is rarely visible in headline statistics. Employment counts jobs, not security. It measures participation, not predictability. A worker with multiple part-time roles appears employed, yet lives with constant uncertainty. Income volatility increases even as employment rates improve. From a macro perspective, the labor market looks healthy. From a household perspective, it feels fragile. Financialization deepened this fragility. As firms became increasingly valued by markets rather than communities, decisions prioritized quarterly performance over long-term workforce investment. Layoffs became a tool to signal discipline. Wage restraint became a virtue. Cost-cutting was rewarded by higher valuations. In this environment, labor is not a stakeholder, it is a variable. Global news cycles reinforce this logic. Announcements of workforce reductions are often followed by stock price increases. Markets interpret layoffs as efficiency gains. The human cost is treated as external. This feedback loop teaches executives that reducing labor costs improves perceived performance, even when underlying productivity suffers. Over time, this behavior becomes normalized. Another critical factor is the erosion of bargaining power. Declining unionization reduced collective leverage. Labor markets fragmented into individualized negotiations. Workers compete not only with each other, but with algorithms, automation, and global labor pools. This competition suppresses wage growth even in tight labor markets. Employers retain pricing power over wages, while workers face inelastic living costs. The imbalance persists regardless of effort or skill. Education was once positioned as the solution. Higher skills were meant to restore the link between productivity and pay. While education remains valuable, it no longer guarantees economic security. Credential inflation reduced its signaling power. Debt-financed education shifted risk to individuals. Graduates enter labor markets burdened by obligations that limit flexibility and bargaining strength. The promise of upward mobility through education weakened as supply increased faster than demand for high-paying roles. Meanwhile, technological surveillance and performance measurement intensified pressure. Digital tools monitor output in real time. Metrics quantify effort continuously. This data-driven management increases efficiency, but also accelerates burnout. Workers are expected to operate at peak capacity without corresponding compensation. Productivity rises, yet well-being declines. The system extracts more value per hour while returning less security per career. Generational effects compound the issue. Younger workers enter markets defined by precarity. They lack access to assets, face higher entry costs, and encounter delayed wage growth. Without accumulated wealth, they rely more heavily on labor income, precisely as labor becomes less reliable. This asymmetry creates a cohort effect, where insecurity is normalized rather than perceived as transitional. Expectations adjust downward, not because ambition fades, but because experience teaches restraint. Policy responses often misdiagnose the problem. Initiatives focus on job creation without addressing job quality. Training programs emphasize adaptability while ignoring power imbalances. Flexibility is celebrated as resilience, even when it reflects vulnerability. The language of opportunity masks the reality of exposure. The emotional consequence is a persistent sense of falling behind. Even diligent, skilled workers struggle to translate effort into progress. Savings erode under inflation. Career paths fragment. Planning horizons shorten. People feel poor not solely because of income levels, but because their economic lives lack continuity. Stability, once provided by work, must now be self-manufactured through constant adaptation. This transformation explains why growth fails to reassure. An economy can expand while its labor force feels trapped. Output can rise while security declines. The system no longer rewards contribution with protection. It rewards ownership with amplification. Until this asymmetry is addressed, labor will continue to produce wealth it cannot claim, and workers will continue to feel poorer in economies that insist they are richer than ever. Debt became the quiet substitute for income growth long before most people noticed. It did not arrive as a crisis, but as a solution. When wages stopped rising in line with productivity and costs continued to climb, credit filled the gap. What began as a temporary bridge gradually transformed into a permanent pillar of the economic system. Consumption, housing, education, and even basic stability increasingly depended not on earnings, but on borrowing. The economy adjusted smoothly on the surface, while its foundations shifted underneath. From a macroeconomic perspective, debt expansion appeared rational. Credit allows households to smooth consumption over time. It enables governments to stabilize downturns. It helps firms invest, grow, and optimize capital structures. In moderation, debt supports growth. In excess, it replaces it. Over time, modern economies cross that threshold. Growth no longer emerged primarily from rising incomes and productivity gains shared broadly. It emerged from expanding balance sheets. Household debt rose steadily across many advanced economies. Mortgages grew larger as housing prices detached from income levels. Student loans expanded as education costs outpaced wage growth. Consumer credit filled gaps created by stagnant earnings and rising living expenses. Each category addressed a specific pressure point, but together they redefined normal life as a leveraged state. Homeownership, once a function of savings and income, became dependent on long-term debt. Education, once an investment with manageable cost, became a liability carried for decades. Even routine expenses increasingly required credit support. Official economic indicators often interpreted this as strength. Rising consumption signaled confidence. Expanding credit markets reflected financial inclusion. Growth remained intact. Yet beneath these indicators, fragility accumulated. Debt servicing absorbed a growing share of household income. Sensitivity to interest rate changes increased. Financial stress became chronic rather than cyclical. People appeared stable until a shock arrived, at which point margins vanished quickly. Governments followed a similar path. Public debt expanded to sustain growth, fund social commitments, and respond to crises. In many cases, borrowing replaced politically difficult decisions about taxation or redistribution. Low interest rates reduced the immediate cost of debt, reinforcing the belief that higher levels were manageable. Fiscal expansion supported demand and prevented deeper downturns. Yet it also normalized reliance on borrowing as a primary policy tool. Growth continued, but it became increasingly conditional on continued credit expansion. Corporate debt added another layer. Firms borrowed not only to invest in productive capacity, but to enhance financial returns. Leverage amplified equity valuations. Debt funded share repurchases, mergers, and restructuring. Balance sheets optimized for return on equity rather than resilience. As long as financing remained cheap, this strategy appeared efficient. It boosted earnings per share, supported stock prices, and rewarded executives and shareholders. It also increased systemic vulnerability. Central banks played a crucial role in sustaining this equilibrium. Monetary policy shifted toward prolonged accommodation. Low interest rates reduced debt servicing costs and encouraged borrowing. Asset purchase programs stabilized markets and compressed yields. These measures were justified as necessary responses to weak growth and recurring shocks. In practice, they entrenched debt dependence. The economy adapted to cheap money. Asset prices adjusted upward. Leverage became embedded in valuations and expectations. This dynamic created a self-reinforcing loop. Rising debt supported consumption and asset prices. Higher asset prices improved balance sheets for asset holders, enabling further borrowing. Governments relied on low rates to manage public debt. Corporations structured strategies around continuous access to credit. Households adjusted lifestyles to debt-supported norms. Any disruption to this cycle threatened not only growth, but stability. Global events highlighted the extent of this dependence. During periods of disruption, authorities intervened aggressively to prevent deleveraging. Liquidity was provided rapidly. Financial conditions were eased to preserve demand. Markets recovered faster than underlying incomes. The message was clear. Maintaining the flow of credit was essential to preserving the appearance of normalcy. Debt was not reduced. It was extended. For individuals, this translated into a subtle but profound shift in lived experience. Stability no longer came from income sufficiency. It came from access to credit. Security depended on maintaining borrowing capacity. Life planning became contingent on interest rates, refinancing options, and credit scores. The future felt fragile because it was leveraged. People felt poor, not necessarily because they lacked consumption, but because they lacked autonomy. Their present was financed by obligations stretching far ahead. The language surrounding debt softened this reality. Borrowing was framed as empowerment, opportunity, and flexibility. Financial products were marketed as solutions rather than constraints. Responsibility was individualized. Systemic dependence disappeared behind personal choices. Yet, when large segments of society rely on debt to maintain basic standards of living, the issue is not preference, it is structure. This is the first half of the debt story. Debt did not merely accumulate, it replaced missing income growth and masked structural imbalances. It allowed economies to grow without resolving distributional failures. It preserved consumption while eroding security. As long as borrowing expanded smoothly, the illusion held. The cost was deferred, not eliminated. The second half of the debt story begins where sustainability quietly ends. Debt functions smoothly only as long as future income can plausibly service past obligations. When that assumption weakens, debt stops being a bridge and becomes a constraint. Modern economies now operate dangerously close to that boundary, where growth depends less on productive expansion and more on preventing the system from confronting its own leverage. One of the clearest signals of this shift is the increasing sensitivity of economies to interest rates. Small adjustments in monetary policy now carry outsized consequences. A modest rise in rates affects mortgage payments, government budgets, corporate refinancing, and asset valuations simultaneously. This fragility did not exist when debt levels were lower and income growth stronger. It is the result of decades of accumulated leverage layered across households, firms, and states. The system no longer tolerates normalization without stress. Households experience this first. As debt servicing absorbs a larger share of income, discretionary spending shrinks. Consumption becomes rigid, prioritized toward obligations rather than choice. Any disruption, job loss, illness, or unexpected expense cascades rapidly. Savings buffers, already thin, are depleted quickly. Financial anxiety becomes permanent, not because people are irresponsible, but because the margin for error has disappeared. Even those who appear stable are one shock away from instability. Governments face parallel constraints. High public debt limits fiscal flexibility. Servicing costs compete with social spending. Political tolerance for austerity is low, yet borrowing capacity is not infinite. Policymakers rely increasingly on financial repression, keeping interest rates below inflation to erode debt in real terms. This strategy stabilizes balance sheets but transfers costs to savers through lost purchasing power. Inflation becomes a hidden tax, reducing real incomes while preserving nominal solvency. Corporations encounter similar dynamics. Highly leveraged balance sheets restrict strategic freedom. Investment decisions prioritize short-term cash flow over long-term innovation. Refinancing risk becomes central. Firms that thrived under cheap credit struggle when conditions tighten. Layoffs, wage restraint, and cost-cutting become defensive responses. The labor force absorbs adjustment once again. Debt amplifies volatility rather than smoothing it. At the systemic level, the economy becomes hostage to its own financial structure. Policymakers cannot easily allow deleveraging without triggering contraction. Markets expect intervention. Moral hazard increases. Risk is mispriced because losses are assumed to be backstopped. Capital flows toward financial engineering rather than productive transformation. The economy appears stable precisely because instability is continuously postponed. Global developments reinforce this pattern. Aging populations reduce growth potential while increasing fiscal pressure. Slower productivity growth limits income expansion. Yet debt continues to grow. The mismatch widens. Economies rely on ever lower rates, ever larger interventions, and ever more complex financial mechanisms to sustain equilibrium. Each cycle resolves immediate stress while deepening long-term dependence. For individuals, this environment erodes the meaning of progress. Paying down debt replaces building wealth as the primary financial objective. Home ownership feels less like security and more like obligation. Education feels less like investment and more like liability. Retirement planning becomes uncertain in systems strained by demographics and debt. People feel poor because their financial lives revolve around servicing the past rather than building the future. Crucially, this sense of poverty persists even when consumption remains high. Goods are available, services function, lifestyles appear intact, but autonomy is reduced. Choices are constrained by obligations made under different economic conditions. The present is comfortable but conditional. The future feels mortgaged. This psychological weight is one of the most underestimated costs of debt-driven economies. Debt also reshapes values. Short-term thinking dominates. Risk aversion increases. Innovation slows outside privileged sectors. When survival depends on stability, experimentation becomes dangerous. Societies become cautious, defensive, and polarized. Economic anxiety translates into social tension. Trust erodes not because systems collapse, but because they feel rigged toward preservation rather than progress. This is why debt cannot resolve the underlying problem. It postpones adjustment while intensifying dependence. It allows growth without distribution, consumption without income, stability without security. It sustains the illusion that the system works while quietly draining resilience. When people feel poorer in richer economies, debt is the invisible force shaping that perception. It holds the present together by pulling the future forward, piece by piece. What people feel today is not confusion, it is coherence. The emotional landscape matches the economic structure more accurately than official narratives do. Anxiety, stagnation, and the sense of falling behind are not psychological anomalies in a growing world. They are rational responses to an economy that produces abundance without translating it into security, continuity, or meaning. When individuals across countries, classes, and professions share the same unease, the signal is systemic. Economic systems are ultimately judged not by charts, but by expectations. For most of the modern era, there was a widely shared belief that the future would be better than the present. Each generation expected higher living standards, greater stability, and expanded opportunity. That expectation functioned as social glue. It justified effort, patience, and trust in institutions. Today, that expectation is eroding rapidly. Growth continues, but belief does not. This divergence explains why prosperity feels hollow. One of the most telling indicators is generational outlook. Younger cohorts, despite higher levels of education and technological fluency, express lower confidence in long-term economic outcomes. Surveys across advanced economies consistently show declining expectations around homeownership, retirement security, and upward mobility. This pessimism is not driven by ignorance. It reflects lived experience. Entry costs are higher. Asset ownership is delayed. Wage growth is uncertain. Debt burdens are heavier. The path forward feels narrower, not broader. This loss of faith extends beyond income. It touches time itself. People plan shorter horizons. Long-term commitments feel risky. Careers fragment. Relationships with institutions weaken. When economic systems fail to provide predictability, individuals adapt by reducing exposure. This adaptation is often misinterpreted as disengagement or lack of ambition. In reality, it is a rational adjustment to volatility. When stability is scarce, flexibility becomes survival. Macroeconomic statistics struggle to capture this dimension. Output can expand while trust contracts. Employment can rise while confidence falls. Markets can soar while households retreat emotionally. Traditional indicators were designed for an era when growth correlated with security. That correlation has weakened. The metrics still function, but their meaning has shifted. They describe motion without direction. Global news cycles amplify this disconnect. Reports alternate between optimism and alarm. Markets rally on policy support. Warnings surface about demographic decline, climate risk, geopolitical fragmentation, and fiscal strain. These narratives coexist without resolution. The public absorbs both simultaneously. The result is cognitive dissonance. People are told the system is strong while being reminded that its foundations are fragile. Feeling poor in such an environment is not about income alone. It is about uncertainty. Another critical factor is comparison. In a hyper-connected world, people constantly measure themselves against benchmarks that are increasingly unattainable. Asset-driven wealth is visible, but inaccessible. Lifestyle inflation sets new norms without providing means. Social narratives emphasize success stories while obscuring structural advantage. The gap between perceived standards and achievable outcomes widens. This gap manifests as inadequacy, even among those who are objectively stable. Importantly, this sense of poverty is not limited to lower income groups. It reaches into the professional and managerial classes. Individuals with respectable earnings feel trapped by costs, obligations, and lack of leverage. Their consumption may remain intact, but their autonomy shrinks. They are participants in a system that demands constant performance without offering proportional security. Wealth exists around them, but it does not belong to them. Economic insecurity also reshapes political and social behavior. When people feel excluded from progress, trust in institutions declines. Polarization increases. Simplistic narratives gain traction. The search for accountability intensifies. These reactions are often framed as cultural or ideological shifts. In reality, they are economic signals. When systems fail to deliver shared progress, legitimacy erodes. The final irony is that the system continues to generate wealth at extraordinary scale. Innovation persists, productivity advances, capital accumulates. Yet the translation mechanism remains broken. Wealth concentrates, risk disperses, debt substitutes for income, labor absorbs volatility. The outcome is an economy that functions mechanically but fails socially. It grows, but it does not reassure. Feeling poor in a rich world is not about absolute deprivation. It is about relative position, future confidence, and control. It is about living in an economy where effort no longer guarantees progress, where stability depends on leverage, and where success feels conditional. Until growth is reconnected to distribution and productivity to security, this feeling will persist, regardless of how high the numbers go. The question, then, is not why people feel poor. The question is how long an economy can rely on numbers alone when belief has already moved on. The economy will keep growing, the charts will keep rising, the headlines will keep celebrating recovery. But unless growth once again translates into security, stability, and shared progress, the feeling of poverty will only deepen. Not because the world is failing, but because the system is working exactly as it was built to.
If you want to understand the economy, stop watching the numbers, start watching who they serve. Because the most dangerous illusion in modern finance is not collapse. It is prosperity without belief.
And once belief is gone, no amount of growth can bring it back.